Hey everyone, my name's Andy. My channel's Finding Value. I wanted to go over one of the comments that was left in the comments section just so everybody kind of gets this response. The question is, I grasp that if oil prices move higher relative to gold, that will decrease the margin of gold miners. All things equal, are you confident that the difference in oil price will be enough to squeeze gold miners to become unprofitable? Let's assume the gold miners have done cost analysis such that they can produce gold at $1,000 an ounce of gold all in. Is the fuel fraction of that total cost significant enough to outstrip the margins gains from increasing gold prices? It's not a one-to-one input-output of oil to gold ratio, right? Have you considered what fraction oil makes up the miner's cost? Now, that's a great question. It is a very good question because I messed this up last bull market in the mid-2000s. So, what I want you to focus on, and as I'm going to pull this up, is the HUI to gold ratio. HUI is the gold miners index, gold bug index. And this is a chart that I got from somewhere on the internet. So what they did is they did the HUI to gold ratio. The ratio tells us strength relative to certain assets. It's the HUI, which is the gold miners index, versus gold itself. This is the ratio. When the ratio is increasing, it means that the HUI is outperforming gold. And when it's declining, it means that gold is outperforming the HUI. And when you look at this chart, you can see that we have an outperformance from the early bull market from 2000-ish, late 2000-ish, all the way to 2004. Then we see an underperformance of the HUI in relationship to gold from 2004 all the way to 2015. Now, this isn't my opinion. This is just history to show you what the history looks like. So it seems like the gold bug index outperforms in the beginning of bull markets, but at the end, when the gold to oil ratio really starts to compress, that we see an underperformance of the gold bug index in relationship to gold itself. I want everyone to understand this because I got caught on the wrong side that previous bull market. I was in gold producers or miners, and they had an underperformance in relationship to gold, and I would have been better off just holding physical gold itself. This is one of the reasons why I am a major proponent of holding physical metals in your portfolio, like physical platinum and physical silver. One, it protects you against many things, and it reduces your risk. Two, it can outperform the miners depending on the input costs and that inflation that happens to those miners. This is also why I really enjoy holding royalty companies. Royalty companies are exceptional because they skip out on the input costs and they give you a revenue stream based off of the output of those companies that they have royalties from and the price of that commodity. So that's why I'm heavily into royalty companies and why I kind of skip out on some of the miners, especially on the backside of a bull market of these commodities. So history has shown that we have underperformance on the back stages, and this could be from inning number 3 to inning number 9 of a bull market in precious metals. I don't want you guys to get caught in it. Now, we can do all the calculations in the world about how their mining costs and how we relate it to oil prices and the increase of oil prices. But what matters is look at history, show us what we've got, and position now just in case this were to happen. I am still positioned in the miners for one last big move in the mining companies. I think we're going to get one very large move in silver miners, gold miners, whatever mining companies, because we still have a gold, silver, whatever ratio to oil is still extremely cheap. I don't think oil is going to take off yet. And I think silver, I think gold, I think platinum, they're all going to take off quite substantially in the near future, which means that we're going to take off with those commodity prices. And I don't think oil is going to necessarily follow with the same speed that these take off. So I think we're going to have one last really good opportunity to invest in the mining companies. That's why I'm responding to this question, is to make sure everyone understands this. I got caught on the wrong side beforehand. Some of the silver miners, because silver is leveraged to gold, may still do well. I don't know, I don't have all the answers for everyone about everything. So keep that in mind. I don't have all the answers here. This is all still speculation on how some of these assets are going to perform against other assets and what those ratios will either compress or expand against each other. So I don't have all the answers here, but I am positioning for one last big move in the miners, and then I'll probably position more so in the physical metals and the royalty companies, and that's kind of how I'm going to position. Again, this is financial education, not financial advice. I appreciate you guys listening. If you like this content, give me the thumbs up. If you feel like this is stuff that you like listening to, subscribe to the channel. And this is Finding Value. Thank you.